Hey there, everybody. Thomas Wood with Basecamp Trading. It is Thursday, May 25th, OPEC meeting day, and we're going to talk about one of the setups we had in the trading room that worked out perfect for a lot of people that were placing the trade, and that was a bear flag breakout or last kiss breakout in crude oil based on a 5-minute price chart. So what we had here is overall crude was heading lower, right? We had started up at a high all the way up at 52. We had come down and dropped, put in lower highs, lower lows, so overall in a downtrend, and we had dropped all the way down to about 50. So we were down about 2 points already. We started to retrace back up, and when we did so, we had really strong momentum climbing right back up with us. You can see we started to climb, momentum started to head up with it as well. We ended up having these two pivots that came along the same trend line, so we had 3 pivot points testing this trend line total. And then if you look at what happened here, our momentum just died. We went from having stronger momentum with rising markets to having rising markets but much weaker momentum. And what that's called is a bearish divergence. And it tells you, hey, get ready. This market could be getting ready to roll over. Now, we ended up dropping down. We broke through the trend line, and then we did what's called a last kiss. A last kiss occurs when you retest broken support now as resistance. Okay, so we dropped through a trend line, we bounced back up and retested broken support now as resistance, and at the same time we formed what we call a bear flag with, again, nice bearish momentum, which would have triggered your entry. And again, if you're in the trading room, we were talking about this as it was happening, would have triggered your entry on the break below 50.89. Okay, your stop goes above the high of the flag at 50.02, so you have about a 13 tick stop. Not bad, $130 contract risk on the trade. We proceeded to then sell off and another bear flag and fall through the floor. Now, if you were following our rules and you were saying, okay, once we start to sell off, where's your first target hit? It's when we got significantly undervalued and then you start trailing by 1 bar, which means you would have been exiting the trade right around 49.75, 49.75. So that means you're in it from 50.75 out at 49.75 or 50 and 50.86. So you're up about $1,100 per contract on the move off of $130 risk. So not a bad trade overall for everybody that took it in the room. I know a lot of people were able to lock in a couple $1,000s in gains just today off of trading crude oil. Now, at the same time, the other thing I want to point out here and make sure you're paying attention to is that it's all about the timing. I know I was watching StockTwits today as this was all going on just to see what people were thinking, and everybody was selling. They're selling here, selling there, selling there, all over the place. Now, granted, it ended up rolling over, and sure, if they held on to their trade, they made money. But the problem is, if they timed their trade incorrectly, they were risking $400, $500, $600 per contract, at least, if their stop wasn't hit in order to catch this move. Whereas if you can time your trade correctly with something like a bear flag on the trendline break with the last kiss, you can reduce that risk drastically, which in turn helps to increase your reward risk ratio, which makes it easier for you to be a net profitable trader overall. And that's one of the things that I really push hard when I'm teaching people is we need to make sure you're timing your trade entries correctly. All right, that's all I have for you for today. I hope you enjoyed it. I will see you in the trading room bright and early tomorrow morning. Don't forget to click that button to subscribe right down here in the bottom right-hand corner. And until next time, happy trading.